Just some more academic evidence behind these intangible factors in terms of environmental, social, and governance. So a Harvard Business School academic paper shows analysis and tracking of these types of factors over a 15-year period on hundreds of companies. And basically the finding is that companies that are systematically measuring and managing these ESG factors can outperform the general market. And in terms of carbon and the Carbon Disclosure Project, for more than a decade, so companies have been reporting environmental exposures through the Carbon Disclosure Project. And today, more than 1,000 organizations are reporting on these metrics, which we just heard some detail on. When Bloomberg analyzed the investment performance of the firms that report relative to the market for the time period, this is 2005 to 2011, and found that companies that are disclosing ecological metrics and are being transparent about their carbon exposure appear to actually be better managed companies. So if these firms were a portfolio, it would have outperformed the general market in that time frame. And we'll hear from Bloomberg in our final panel this morning. So the reason that we say at my firm human impact plus profit is because investments that value ecological and human capital factors mitigate risk and can actually enhance portfolio return potential. So this leads us to our first panel of leading investment practitioners for institutions. So we have a deep investment management experience before us who will talk about the process of divesting and the fiduciary considerations. And I will turn it over.
I think this works great. Good morning, everyone. I have a couple questions as well for everybody. How many people here, I'm going to stand because I know it's been a long morning, very inspiring with Mr. Massey and with the sustainability information. How many people here believe that the Earth has been visited by aliens? Please stand up. Come on. How many people here, you clearly didn't read Week in Review, I guess. How many people here believe that humans are the cause for climate and global warming? Okay, well, that's an interesting factoid. So, for Nicholas Kristof wrote a piece in this week's Week in Review. 77% of people believe that the Earth has been visited by aliens. 44% of the people believe that humans are responsible for global warming. That's what we call the Roger Ailes Fox News effect. Okay, one more time. One more question, two more questions. How many people here believe that you would have to give up return for divesting from the fossil fuel 200, the carbon tracker 200? How many people here believe you have to give up return for doing that? Oh, come on, guys. Limit your universe, limit your return. None of you feel like you have to give a return for doing that? That's fantastic. That's impressive. That was unexpected.
Here we go, we're done.
Okay, exactly. Okay. So first, who am I? I'm Tom Van Dyke. I work at the Royal Bank of Canada. I run the SRI Wealth Management Group there. We consult on about $1.5 billion. All of it has some sort of ESG screen on it. I also am the founder of the As You Sow Foundation. I'm going to introduce the other panelists in a moment. I want to talk about what Bob Massey did a great job discussing, which is what is the issue. He talked in terms of carbon, which is the circle to the your left as you're looking at the screen. I'm going to talk in terms of carbon dioxide. The ratio is essentially 1 ton of carbon equals 3.67 tons of carbon dioxide. So that's where the numbers can be a little confusing. But this is the issue of what the carbon bubble is. There's essentially 2,800 gigatons of carbon dioxide identified on the balance sheets of the fossil fuel companies today. There's only 900 gigatons of carbon that can be burned before we get to the 2 degrees Celsius level that everybody in Copenhagen agreed to. In fact, it was the only thing they agreed to. That includes the United States, China, and India. How long is it going to take us to get there is a matter of debate. Price Waterhouse a group not too well known for its extrapolating and far-flung statements, thinks it's going to take about 21 years. Jim Henson, in a recent piece, thinks it's going to take quite a bit less. And then there are others that'll think it'll take a little bit longer. But 21 years is about the period of time it'll take to get to that point. And you have to ask yourself the question, as Bob did, like, look, if you're spending $684 billion a year in CapEx spending as an industry, and most of that money is being looking for new reserves, what are you doing? If you can only, if currently you can't monetize 2/3 of what's already on your balance sheets, why aren't you taking that excess capital and either investing in paying your dividends back, buying your stock back, or diversifying your industry? Are there costs associated with climate change today? The top chart shows that in 2012, we spent about $139 billion just in the United States dealing with climate disasters. Now, whether that's floods, fires, droughts, as California is going to go through, whether it's tornadoes or hurricanes. Insurance companies picked up approximately 25% of that cost, which means that the U.S. taxpayer picked up about $96 billion in costs associated with climate disasters in 2012. That's more than we spent in transportation. That's more than what we spent on education. And it's second only to what we just spent on defense. If you extrapolate what Bloomberg's put out, which is a 30-year piece of data on different climate disasters over the last 30 years, in about 10 years, we'll be spending between $200 and $250 billion as taxpayers dealing with climate disasters. That's essentially what we were spending in defense under Clinton from the standpoint of costs. So the costs are accumulating now. And they're landing on the balance sheets of taxpayers. They're landing on the balance sheets of industries. The pine nut beetle is sweeping through the Western Rockies from Colorado all the way up to British Columbia, destroying tens of millions of acres of timber, which the timber companies then cannot monetize as effectively to produce housing with, and is used as a biofuel as opposed to for housing. So the industry is externalized, the fossil fuel industry is externalizing these costs onto different balance sheets. Healthcare is an issue. Eric Lerner's in the audience. We have healthcare costs being passed on. We have healthcare systems absorbing those costs. With Sandy in New York, below 35th Avenue, the Langone Hospital spent $1 billion basically rebuilding itself. They were prepared for a 12-foot surge. It was a 14-foot surge. So the costs are flying off the balance sheets of the fossil fuels companies, landing on balance sheets of taxpayers, other industries, and healthcare that we're paying for, and their shareholders are making money. There's also real estate costs, there's agriculture costs, and it kind of goes on and on. And so we're going to talk about not only what's the math situation around divestment, what are the costs, and how can we do that effectively. We're going to talk about engagement of these companies with Leslie. We're also going to talk about the idea of where can you invest and how broad is it? Is clean tech just wind and solar? Or what we're really talking about is something that's going to transfer the entire economy, where you're involved in industries that deal with water, energy, transportation, agriculture, waste management, housing, LED lighting. I mean, it's going to affect every part of the economy. So these are the questions we're going to bring to our panel today, and we have three very distinguished people that can talk about this in different ways. We have Patrick Geddes, who is the Chief Investment Officer at Aperio Group. Prior to that, he was Chief Financial Officer of Morningstar, the mutual fund rating system. And prior to that, he was Director of Quantitative Research at Morningstar. But the fact on Patrick's actually resume I like the best is he spent 5 years as an analyst at Amoco Oil Company, which is now owned by BP. And I guess you did a number of work dealing with like various quantitative analysis dealing with currency hedging, corporate tax, etc. So welcome, Patrick. We'll get to you in a minute on the discussion of math. Leslie Samarich is the Chief Investment Officer of the Green Century Fund, President. And they run about $180 million, as we found out just a moment ago. They are fossil fuel free. What I found out today, though, is they're actually owned by the PIRGs, which is the Public Interest Research Group. So their money goes to help support the PIRGs, which is nice to know. And before that, Leslie used to work as the Chief of Staff at the Corporate Accountability International, and before that was Executive Director of Green Corp. Welcome, Leslie. And then we have Ken Laughlin, who's the Managing Director of Impact Asset Management. He's responsible for the investment team and building the business in North America. And they're a group out of London that deals with investing in both positive and sustainable companies that have great environment, social, and governance practices. He's been in the business for about 30 years, and he's 20-year commitment to clean energy enterprise investment. Previously, he was the Director of Finance at the Clean Energy Group, and he worked with Ceres. He's also been a part of the Massachusetts Green Energy Fund Management, and he's a founding co-chair of the American Council on Renewable Energy, which is ACOR, which is what is his button on his lapel. So welcome, guys. Welcome, Ken. So Patrick, first to you. Can you discuss there's a number of studies that are out showing that you don't need to necessarily give up return for pursuing and removing the fossil fuel 200 from your investment portfolio. Could you discuss the work of Aperio in that area?
Sure. So, my firm, Aperio Group, we approach this from the perspective of using traditional, perhaps past-looking, to refer to Bob Massey's description, risk models in terms of looking at what impact does it have on a portfolio to divest or perhaps overweight more environmentally friendly industries. And the question that most commonly gets answered is, as Tom alluded to, aren't you giving up return by making this sort of investment? Unfortunately, the data are kind of weak on this, and I would urge everyone to be a little wary around the stuff that's saying that you will outperform by divesting. But the good news is that there's really no evidence of any kind of penalty. And so the skeptics will say, you are basically guaranteed to lose money. And I always want to turn that around to, really? Then you should be beating the market on a regular basis if you know that's a fact. And of course, they're not. So there's a lot of skepticism here that's actually based on some really bogus math. And we're big fans of McKibben's concept, do the math, and would apply that to the same, to the investment side, do the investment math. And that's what I want to run through. So on the return side, there's a UN study of 20 different published research papers, more broadly than just environmental, kind of mixed, slightly positive, but inconclusive. That's going to bring us more to the risk side, because that's where you can actually do have a lot more confidence in a lot more detail. So I'm going to start with a concept from the institutional space called tracking error, which if you're an investment geek, you talk about all the time. If you're a normal human, you wonder, what? So I use the analogy of a dartboard, and the concept of throwing darts in terms of returns over time, and the idea of a very low tracking error portfolio, like an index fund, would basically, it's always going to hit its benchmark. And so the tracking error is in effect zero. A very low tracking error portfolio is one that you're very closely dispersed around the bullseye, as opposed to a high tracking error portfolio, you're all over the map. Why do we care about this? Because it's the thing that investors are most concerned about in terms of, if I'm going to be earning return, I always have to measure the actual risk I'm bearing. So let's cut to the chase on the divestment side. And I've got up here 3 different versions of how far one can go on divestment. One of the interesting things about measuring the investment impact of divestment is there are a lot of different ways to do this and a lot of different levels. The far left, I've got just excluding the filthy 15. The only reason I threw that in is simply to point out that getting rid of the 15 worst companies is almost irrelevant. All right, let's go to the full carbon divestment. That's the one I want to talk about the most. So that portfolio is taking a slightly different stance from the Carbon Tracker 200, and just saying, let's make this really simple. Let's just get rid of an entire industry of oil, gas, and extractive fuels, which is coal. And that gives you a tracking error of 0.6%. All right, again, if you don't work in the investment world, what the heck does that mean? The average active manager takes 5% tracking error in terms of, that's the average active manager for big institutions. So by comparison, this is actually pretty tame, but the real number that matters is not that 0.6, that's all about the dartboard. How much are we around the bullseye? The number that really matters is what's the true impact on my total portfolio risk? Because portfolio risk is the stuff that makes us queasy. It's like the market pays you for the strength of your stomach lining, and the more you got to ride the roller coaster, the unhappier you are. That's standard investment theory. We call it risk and return. It's really about fear and greed. So how bad is that 0.6? How fearful does that make us? Well, the actual incremental risk impact is 0.01%, which we would call noise. In fact, Bill McKibben did a great job when he cited some of these numbers in a presentation at Middlebury, and he said, no one's claiming that divesting in the public equity space, completely divesting from oil, is absolutely free, has absolutely no impact. But it's basically trivial. You can convert that 0.01% to, aren't you actually giving up return? I almost stood up when you said, are you giving up return? I was thinking, yeah, but it's a rounding issue. So I would argue that, yeah, you probably are giving up about, using historical risk-return relationship, you're giving up about 1/3 of a basis point, 0.03/1000%. And I'd say that's so irrelevant in a world where we may claim we know what's going on the investment side. Very, very hard to predict. So basically, it's noise. And I would say that the skeptics claiming it's going to have a big impact on the using traditional quantitative institutional risk models, that's bogus. You may have other reasons you want to talk about divesting, but that one's bogus. Okay, let's go back to return. I'd mentioned some of the academic studies. This is an historical simulation of looking at rolling 10-year periods of a divested portfolio using what's called a multi-factor optimizer. Basically, get as close as you can to a benchmark, in this case, like the total US stock market, but getting rid of this one industry. And you see that over time, you've actually been slightly ahead for divesting. We just went back as far as we had data in our model. I would not count on that as an investment neutral person. I would not bet on outperforming, but it's showing it's very minor. Now, let's look at the last couple of years, excuse me, the rolling 10-year periods. Well, the American Petroleum Institute just issued a paper on how important it is to own energy stocks in a portfolio. And they picked a 10-year period. Now, looking at that graph, the positive means it was better to divest, and the negative means it was worse to divest. Which period do you think they picked? I'll give you a little hint. They picked the stuff way over here. Now, if you were an activist saying, this is great, you'd pick something like around 1998. I would argue the math actually suggests it's not going to have much impact. It's going to swing both ways. Effectively, it's going to be noise, and it just doesn't make that much difference. And this is not just our firm. A number of firms offer this, and it's very well documented. There are 4 peer-reviewed academic journal pieces that support this methodology. So this is not just some highfalutin concept. This is very anchored.
Okay, so Patrick, let me ask you a question about tracking error a little bit. So that means that you can only deviate if it's 0.61 on the last chart that you had back there. Let's go back that chart so we can see this. So this is on the, what index is this on?
So this is tracking the Russell 3000, so the total US stock market, and we're saying that it's measured in standard deviation, so we're saying that 0.6% is going to be the standard deviation of dispersion around the return of the Russell 3000.
Which basically means you can either be up 0.6 or down 0.6%. So you're not
about 2/3 of the time, and you could be a little worse. So basically, it's going to swing around as we saw in the historical.
So you're not going to outperform or underperform by a whole lot.
Correct. It's very close to just being a standard kind of indexing approach of let's just buy the US economy. In effect, the reason you can do that is you're buying the US economy less oil stocks, but you're telling the model, get me as much exposure to look as much as possible. In other words, counterweight all the risk brought by the divestment.
So now I'm noticing that there's only 134 companies in that observation, but the carbon
that were kicked out.
They were kicked out.
Right.
The Carbon Tracker 200 has 200 names.
Yes, Carbon Tracker is international.
So
this is domestic.
This is domestic,
and this is just industry specific. This is a simpler version. The Carbon Tracker 200 might have very slightly tracking error, but it's going to be very close.
So you're eliminating all of the industries according to MSCI, or in this case, S&P or the Russell.
Right, it's called the
Russell
GICS.
3000.
The GICS industry standard.
Okay, so which industries are you removing specifically?
Just one industry, oil, gas, and consumable fuels, which is basically coal.
Okay, and no mining, because we saw from Sustainalytics, there's mining.
So you add in
utilities.
mining, and the tracking error would go up slightly. Different investors may want to have a stricter version. What's so great about using this kind of approach is you can set the bar wherever you want in terms of how much risk are you willing to take, and you get the control over that, and you may have what an environmentalist would say is too watered down an approach, but you can control that as an investor.
Okay, and so if you put in the metals and the utilities, then it would be 0.7 or so?
Yeah, sort of 0.7 up to 0.9, depending if you're also adding a more positive reinvestment approach, for example, including firms that are heavily weighted in terms of their revenue from sustainable industries, and that would tilt it up slightly higher than that, up to say a 0.9 or 1.0%. And again, you have a lot of control there if you want to go beyond just divestment and overweighting the more environmentally positive companies.
Is that what the full carbon plus positive
Yes,
does?
yeah. So the full carbon plus positive adds in, it takes this second one and adds in some data from MSCI, what they call their environmental innovators, based on revenue, which is adding it's about 8 to 10 times higher than the market's exposure to industries like pollution prevention, sustainable clean energy, sustainable water, sustainable construction materials, etc.
So if you were to do that, then they have a 0.91 tracking error.
Right.
So that's like an invest-divest option.
Right. So that's a more aggressive one. You've got a little bit higher tracking error. It's really an investor's choice. Kind of the point of the slide is you get to control how much of that risk, as opposed to the skeptic's comment is you're in trouble. Well, let's actually measure. And that's, I think, another point on this slide is when people are telling you you're going to be harmed by it, ask them, can you quantify that? Can you measure the extra risk we're bearing? And if they aren't answering it, they're basically dodging the question.
So are you noticing investment consultants? And by the way, from a consulting perspective, if you have 0.5 or less in tracking error, that's considered an index, essentially. If you're between 0.5 and 1.5 in tracking error, you're considered an enhanced index. If you're over 2, you're considered active management. So when pension funds like California are looking at different managers, that's how they kind of track it from a tracking error perspective. You really can't dramatically outperform or underperform without large tracking error, okay? Because the tracking error is to track the various benchmarks. So the message here is there's no, essentially you are the index by pulling
right,
up.
and it's a trivial impact to do just an industry divestment.
Now, are you noticing any biases from the financial consultants one way or the other in this area since you present this data all the time?
And I have seen, I mean, I mentioned the American Petroleum Institute, they have an obvious bias. The consultant business to the pension funds, I think a lot of them are pretty reluctant to be dragged into this issue, and they get asked a lot by clients. We keep hearing a lot of frustration from big pools of public money of why are we not being heard on this? And I think there's a bias from the investment consulting side, because part of what we're talking about here is actually more of an orientation toward indexing, what's called passive, and the investment consultants have a very strong vested interest in what's called active management. So one word of warning I'd give to anyone looking at this issue is please pay attention to the economic incentive of anyone giving you advice. That applies to me too. I'm in the indexing space. I work for a for-profit money manager, but look at the data and pay attention to the biases that can creep in.
Regardless of the bias, you can clearly do it.
Yes, and look at the data.
And look at the data.
Yes, so to try and
Time
move it to the data and look at measuring not only the investment risk, but some of the environmental factors, as we heard from, say, Sustainalytics or folks from Bloomberg.
Okay, great. Thank you, Patrick. We'll be able to allow you to ask questions, Patrick, here in a moment. I want to get Leslie here next. So, Leslie, let's talk about, so as the different pension funds, endowments, and foundations are discussing divestment, then let's talk about the shareholder engagement portion. What's currently being asked of management teams, since they seem to be spending this excess capital in ways that is dangerous to shareholder value and to fiduciary responsibility? What's currently, being asked of the management teams this year?
Of the fossil fuel companies?
Fossil fuels, utilities.
Is this on? Yeah, thank you. There's a number of investors who are asking them to report on their carbon risks or their carbon bubble.
Okay, and are you guys at Green Century leading any of those? And what has been your experience in filing shareholder resolutions? I know you're very active in that area.
Right, we have been active for about 20 years doing shareholder activism. We have actually chosen not to do that this year and will not be doing that. We are instead spending our time and attention on advocating with other industries to get them to lower their carbon footprint. So we just don't think it's a very effective use of time, and the prospects for success are low, as Bob talked about. And the sort of more encouraging thing, especially for institutions or individuals who want to be doing shareholder activism, there is lots of opportunities to actually impact global greenhouse gases and climate change through other kinds of advocacy. And maybe we'll get to that in a sec.
Well, let's discuss that. So, so are you noted? What type of advocacy would you recommend, and what are you seeing? Are you seeing that people are? Bob mentioned that this carbon risk is going to be on every single industry and it's on every single balance sheet. What are you doing in that area to engage companies that are normally environment, social, and governance oriented?
Sure. Well, there's the historic and still useful ask of asking companies to set greenhouse gas goals. I mean, just in the prior presentation, we saw that only 27% of companies have those goals, and there certainly can be more progress there. Every company is using energy. One of the interesting things that we have done this year with the other institutional investors is go after, starting last year, addressing the issue of palm oil. Are people familiar with palm oil? Okay, so it's the most widely used vegetable oil. It's in nearly, it's in lots and lots of things. Last year, we started asking Starbucks to only source sustainable palm oil so that they're not raising and burning rainforests and getting rid of this, both, the carbon emissions right away, but also long-term, the rainforests that are trapping carbon. And this year, following up on a long campaign by a number of groups, some of whom are based here in California, like Rainforest Action Network and Friends of the Earth and Greenpeace, targeted Wilmar, which you may not have heard about. They're the largest palm oil supplier, though, in the world. And after this campaign had raised the issue, they were close to announcing a really precedent-setting deforestation policy, which they said, we won't grow palm. We won't grow palm without by cutting down rainforests any longer, because there's an alternate sustainable way to do it. But they were waffling right at the end. So Green Century organized 40 other institutional investors and sent a letter, and it came right at the sort of coattails and the end of this, and we have helped convince Wilmar and Unilever to announce that they have adopted this really game-changing policy. So that is just one example, but there are many, many opportunities, palm oil and beyond, that shareholder advocacy can play a huge role in, and I think that, from our point of view, that is the place where energy and time will be more productive.
Right, so coordinate with grassroots groups like Rainforest Action. In that case, I think everyone's probably aware of the orangutan and the free range video that kind of went viral promoting the palm oil situation. and that shareholder engagement can actually accelerate the pace of change, working in conjunction with those nonprofit groups to make that happen.
Right.
And so what other areas you've seen that industries that you can bring up the issue of carbon exposure that they seem to be listening to? Are there other areas that Green Century is focusing on?
We are also working on tar sands issues, one of the most environmentally destructive ways to source fuel. We're working with, I think Peter here is here from the Sierra Club and Forest Ethics, working to get, particularly this year, we're working to get Pepsi to both improve its fleet fuel efficiency as one of the larger fleets in the country in terms of moving all that soda and water and other products around, but also getting them to only use fuel that is not coming from tar sands. So that is probably an ongoing issue. It's a little complicated on the distribution end, but
are they dialoguing with you? How are those?
Yeah, we've been in a couple dialogues. The NGOs have had a few dialogues. We have a call tomorrow at 3 p.m. with them to figure out whether they are going to agree to it, and if not, we will be going to the ballot, and then shareholders can vote. And that is the other thing that we haven't really talked about, is that especially if you're a large institutional holder, voting your proxies in a way to support the other advocacy efforts that are out there can be very powerful. It is extremely rare that a shareholder vote passes, like in a ballot campaign. You're not looking really to get 50%. What you're looking to do is get something in the 20 to 30% range that's enough of a signal to the company that, wow, our shareholders really care and it's important. And there is an intrinsic value also in just the larger institutional holders voicing their opinions and concerns directly to management and voting their shares in support of it. So a lot of larger institutions get their information from these proxy advisor services, but there's a whole other network where you can get direct information on what are the shareholder votes coming up and where you could vote your proxies. That's I think a really good first step for people who are looking to do more with their ownership shares.
And if they have mutual funds, how do they go about checking that to make sure the mutual fund's voting their proxies?
I wonder if I'm not sure if there's a place where you find it, but they should ask their mutual fund company.
Pressure them.
Right, and pressure them. I mean, if you're invested in socially responsible funds, it is more than likely that they are voting that way. I would particularly ask them for the record on climate change issues. It is really their fiduciary responsibility for mutual funds to be voting their proxies. A lot of times they don't vote it. They may not be voting it in the way that you would be wanting them to vote on issues that you may care about. So it is important to ask.
But in the issue then, getting back to the fossil fuel companies,
yep.
There are shareholder engagements right now asking about what are you doing with this carbon risk?
Yeah, and there was just a recent, I would call it a victory, right? With the As You Sow and Connecticut, and there's another state, New York, that with First Energy, a large notorious energy company out in Ohio, asking them to come up with what is your plan to deal with carbon and reduce greenhouse gas emissions. And so through dialogue, they are coming back and saying, okay, we'll come up with the plan. So I think it remains, to be seen, like, well, what is that plan? Is it good enough? But it's a good first ask, especially if your institution is on the way to divesting, which I hope all of you are, that as you still hold those shares, you can do some advocacy on it while you ramp up with the non-fossil fuel companies.
Right, and that's also being asked, I think, of Chevron and Exxon. Essentially, what is your plan in dealing with these stranded carbon assets as we try to move towards Obama's 80% reduction in carbon
right.
by 2050?
And I would say that our experience with Exxon and Chevron is that they are not trying to change their core business. I mean, that's not where shareholder advocacy shines. It shines in these other arenas, as Bob also mentioned. But there is an opportunity there if we hold some of those shares in our management company, so if they're not in the funds, to actually generate media around how little they are willing to do it. So if you still have them, you can do that.
You did have some experience with that, didn't you, with Chevron?
We did. And this is one of the reasons that we are in the situation in place that we are about shareholder advocacy, in part with fossil fuel companies, is that about a decade ago, we were doing advocacy out of our management holdings, and we actually got Chevron to agree to pull out of tar sands, which was awesome, and we thought a huge victory, until 3 years later that they reneged on what is essentially a voluntary agreement, and went back in. So and there's no, as far as I've been asking, but I cannot find any other track record of success in terms of engagement with fossil fuel companies that goes to their core business of reducing the production or refining or exploration of fossil fuels. And I feel like, okay, well, if we're the only firm that had one, and ours basically gets up in the fail category ultimately, that's probably not the way to go.
So you're saying this might travel the track of tobacco divestment more effectively, where it goes to divestment and litigation, as opposed to necessarily dialoguing with them about undoing their crux of their business plan.
Right, I think it could. I think that's a good strategy or tactic to use later on. I think in the meantime that divesting, someone else will buy the shares. So that is really not the point of divesting. It is because there is this almost, I don't want to say last resort, but final stage. I mean, we've been trying at the policy and engagement level to get the companies to not have as much influence on our state and national policies. And largely, even despite groups like the Club and Environment America and lots of other organizations who have awesome field and policy people, we're not really succeeding. And so we need something to loosen the grip that the companies have on our policy. And so because this is the movement, this is the strategy that has ignited climate change activists like nothing I have seen really in the last decade, that divesting now actually just lends to this groundswell with the media and the momentum. And this, I think, is our best bet to kind of change it in the time period we need to change it before it's too late.
Well, that's a great segue into Ken and the various options. So can we effectively diversify our portfolio and look for companies that are focused on sustainability?
Thanks, Tom. I certainly think we'd like to think so. See how they're doing it now? They're turning the lights down. They turn the lights up when Leslie was speaking because she actually looked better in the lights. Some very thoughtful, and thank you for this, person up there took a look at me and said, now we're going to bring those lights down, which we need to do because we've got slides coming up in just a minute. Brett, can I ask you to push the buttons on that for me? Because I'm going to have two hands, and I want to keep my notes with me. You've only got one excited. He's got them right there. So as Tom said, this is an area in which we as a firm at Impacts have been working for, and my apologies over here, I don't have that much lateral movement in my neck. We've been working in this low-carbon investment arena for 15 years. We manage $4 billion worldwide. It's all that we do. It's always been all that we do. We manage a total of 23 funds in different markets around the globe, including one fund here in the U.S. Called the Pax World Global Environmental Markets Fund. Bob Helmuth from Pax World is here today. So this is an area in which we're very dedicated, but it's an area in which we're dedicated because we think this is the right commercial choice. The decision we made predated a lot of the conversations we're having today, and we made it because we felt there were opportunities for investment return, which would be better than what we could see in the broader market, and I want to talk a little bit about that today. Can you give me the next slide? So what's interesting about this marketplace is that people come at this question of investment, and they have two kinds of complaints. If you suggest them to a fiduciary that you consider investment, they'll typically give you one of two arguments. One argument is you're going to lose all your money, can't do it. And Patrick's analysis and the analysis of half a dozen other firms, some of them more index-oriented, not quite so analytical, have consistently shown the same pattern. That's just not true. So then the next argument that you tend to get from people is, well, these sectors are interesting, but they're too narrow. You can't absorb the volume of investment that's required. They're too small. They're too concentrated and niche-y and not attractive from an investment perspective in the bigger scheme of things. Well, we've been working in this area for a while, and we don't think that's true. And the way we see that is that we have worked across a range of investment opportunities. You can see them up on the board there. These are the subsectors of something called the FTSE Environmental Markets All-Share Index. And FTSE is a major London-based index provider. They put together this list of all the major low-carbon and environmental sectors that they thought existed in the global economy. What's particularly interesting to this overall list, if you look at it, is what you're going to see when I ask Brett to start clicking. And you're going to see a series of these light up. And as they light up, you'll see that virtually every subsector up there has a direct impact on reducing carbon until you get down to carbon trading and carbon asset trading. 21 of the 28 subsectors directly impact the low carbon economy. This is a very wide range. We've got the opportunity to invest in big wind farms. We can invest in little tiny battery charging operations. We can invest in more efficient agricultural production. We can invest in GPS systems. We can invest in turbochargers. It's an enormous range. And as a result, while we've been doing this, it's been quite successful as an investment strategy. This is in listed equities. We can talk later and talk this afternoon about some of the broader ranges in the economy. I think listed equities, as Bob was saying, have seen more progress around this class of new opportunities than some of the other asset classes. But we also manage in private equity. We've seen very good returns for our private equity investments in project finance associated with renewable energy projects. Fixed income has been a challenge. Bond and other fixed income debt instruments has been a challenge for investors. The World Bank and then the Nature Conservancy and now others have begun to support very interesting green bond initiatives that offer investors that opportunity in their portfolio as well. And now we're even seeing corporate investment opportunities at the bond level. Solar Cities bonds, solar bonds, and Enel, for example, in Europe, have begun to issue bonds that really directly connect to the low carbon economy. So we know that these companies that are in the space don't do less well overall financially. That's what Patrick's research is helping show us. There's also no reason to assume that they're not well managed. So if you go to the next slide, here's a sense of just how fast that universe has grown. When we started, there were 250 companies. There are 1,500 in this universe today. Really a substantial expansion of the market. And the big issue for us is we can invest in a very wide range of companies that are good when markets are up, and also companies that are good when markets are not doing so well. Next slide. So here is a list of the top 10 companies in the MSCI fossil fuel, actually it's the MSCI Energy Index, which is dominated by fossil fuel companies, as you can see. As it happens, 9 of the 10 of them are in the Carbon Tracker 200. Only Schlumberger does not hold reserves that put it in that class. So it's a very high carbon class of investment. That doesn't tell you anything directly about the management of the companies, but you do see BP up on the list. And from my point of view, that tells us something about the kind of management that we're seeing from some of these firms. But if we look at the flip side, to go to the next slide, and we look at the companies that are in the top 10 holdings in the index of low carbon companies, you'll see names that you know for the most part, but they're companies that are all involved in fossil fuel activities, and they're companies that have been very successful in their commercial orientations, and they're companies that have very interesting aspects to their management. So Honeywell, for example, had its CEO named in 2013 as the CEO of the Year by Chief Executive Magazine. Siemens had more low-carbon patents in their company in 2013 than they've ever had issued by the company any time they have in the past. And Johnson Controls up on the list as well. Johnson Controls this year was awarded one of the world's most ethical companies for the 4th year in a row. So these are companies that investors can be proud to own, I think. Next slide, please. So the real question then becomes, what happens from a financial perspective? This is what happens if you map the returns from this index. This is not a fund we manage. This is the index itself of all the low-carbon companies over the last decade against, in this case, the MSCI World. So just a general proxy of investment returns. There is significant outperformance over the decade. In fact, it's almost 4% annualized, almost 4% per annum of outperformance over the last decade. So we would argue that people who say, well, you can't do this because you're going to lose money, don't understand the opportunities, the alternative investment vehicles that they have in front of them, and those of which they can take advantage. And we would also suggest that investors who hear these concerns about fossil fuel challenges and the issues associated with fossil fuels over time and potential for stranded assets, investors looking at those concerns should think about whether it's not time to stop focusing on being part of the environmental problems associated with fossil fuels and look at investing in the solutions to the carbon issues.
Ken, I have a question with this slide. So does this include the solar and wind companies? Because my understanding was until last year, they were down about 30% per year for 3 years running as industries. So does that include the solar and wind companies?
It does, and that's very important. A lot of us have lost money in solar companies, and despite the fact we think it's a wonderful sector, it is the case that it's extremely volatile.
Until last year.
And again, but still, if you started at the beginning with the very beginning of the Wilder Hill, you're only about 30 or 40% down today. So it hasn't been a great sector over its sort of 10-year history. This index tracks the broader range of activities that are associated with low carbon investment, and that's the key. It's easy to pick one industry and argue that, and one period of time, and argue that you don't want to hold that. The real question is what happens if you invest across a major portion. The companies, those 1,500 companies have a market capitalization of about $4 trillion. So it's a very large market that we're talking about in which investors can position themselves. And there, even the significant drops in one sector, solar or wind, for example, don't wash out the positive benefits over time.
So even with those numbers in here, your companies did better because they included that, or at least the fossil fuel-free index, because that's reflected there. So this is the same time frame I think that the oil companies chose. This is the last 10 years from the standpoint of saying that if you had oil companies, you would underperform, correct?
Right.
Yeah, from that perspective.
They were comparing to the total market.
Well, this is comparing the MSCI. Is this compared against the MSCI in general?
MSCI World against
World.
This index, which is obviously a relatively small subset of the larger.
How small of a subset is it?
Well, so 1,500 companies between $3 and $4 trillion in market cap for those firms. So it's a material percent. We have seen sort of numbers between 7 and 9% of the global economy is tied up in this activity.
Okay. So the UN report that came out last week was saying we need to put $1 trillion a year for the next 36 years into climate solutions, broadly defined, okay, in order to transition our economy, and that's a pretty tall order. So these companies can take some of it, but then you were mentioning some of the bond financing, the solar cities. They actually, I think, didn't they get a triple B rating, investor grade rating by S&P?
They did, and the World Bank, of course, comes out with green bonds with AAA ratings because of its financial strength. It's very important for investors to recognize that we're only looking at a slice of the equity markets here. In a well-functioning economy, the debt markets represent a bigger piece of the industry activities than the equity markets. That's how you keep costs down for the execution of the company strategies. So the development of green bonds has been very important. It has lagged. Honestly, I've been working from a distance arguing for it. I don't do debt side work, but through the Investor Network on Climate Risk, pleading with folks to do more in this direction. And just this year, a leading group of banks have issued a set of principles to support green bond activities. And we went from a half dozen to pushing 100 issuances last year, and that number is going to move up very quickly. So this market of non-carbon investment opportunity is expanding very, very rapidly just in time. Still a big lift, but it's not impossible.
Are you noticing that the companies are potentially ahead of the investors in this area as far as identifying how sustainability and efficiency are leading to margin expansion in a low margin environment?
If you look at the number of major firms, I mean, if we go back to the slide with the top 10, Brett, on the EOS, if you look at the names on that list, these are companies that have somewhere between 20 and 100%, well, probably 20 and 80% of their business directly connected to low carbon investment. Those names have come into that list principally over the last 5 or 6 years. They are companies that are recognizing the opportunity. They're major firms that are buying up what were companies, often companies we own, and thank you very much, we're happy when that happens, buying up those companies to put them in a big company, and in many cases that is enough to increase the level of low carbon activity in the big company, so that company comes into the index. So I think there's not any question that, with the exception of the fossil fuel industry sector, for reasons that are fairly apparent, virtually every other major industrial commercial sector is looking at how they address this problem. Fleet operators are looking at it. Mining companies are, consumer companies are looking at it. It's funnily enough, there's just this one group of folks whose existence is defined by it's in the name of their industry, the fossil fuel industry, who can't make any progress.
Now, would something like a Google, who is looking at building offshore wind on the East Coast, be something that would be potentially considered for a fund like yours, or is that just too broad? Because that is an example of a company that's actually looking at a way to fix their costs, because they do a lot of cloud computing. I mean, it's interesting, you'll note that some of these companies, you ask, can I buy a 20-year power purchase agreement with natural gas? We should probably ask that as shareholders, can we do that? But as consumers, you ask that question, and you cannot get a natural gas company CEO to commit to a price for 20 years forward-looking on natural gas. But you can, as a company, ask a solar company or wind company to give you a 20-year price on wind and on solar, which means they can fix their costs going out 20 years over a long period of time, which is what Google essentially is doing, why they're debating putting wind in, because they don't want the variability. They don't want the front-end volatility associated with fossil fuel pricing reflected in their business models. They want to be able to allocate capital a long period of time, and for that they need consistency, and they need to be able to have predictability. And so they're basically looking at wind and solar. But a company like Google, that's doing that, would not necessarily be in your fund, but could be an example of a company that's looking at sustainability.
That's right. And in this case, all the companies that on this list and all the companies that are in part of that broader index have at least 20% of their commercial activity directly connected down to the level of the product, because we research this, in their low carbon environmental activities. And what happens is that companies who move into that list inevitably keep going up. The levels, they cross over at 22%, you come back and look at the next year, it's 25, then it's 27. GE has gone from almost 0 to about 12 or 13% now. They're not on the list. So Google could get on the list if they put a lot of money, because they're a very big company, and I would think that's a wonderful goal for them. Since we're in the neighborhood, we should suggest that.
There'll be opportunities this afternoon to ask, I think, each of these panelists for questions. Thank you very much.